Hey guys, this is Des Morris here with the Des Morris Investing Channel, and I have a great guest for you guys today. I have Justin Petrillo. He is the founder and creator of Exponential Investments. Exponential Investments is a investing group where the plays are shared. New people are helped and guided, and various things like that. So Justin, if you could tell us a little bit about what got you into investing, your background in investing.
Sure. Well, first, let me start by saying thanks for having me on the channel here. Thanks for having me on the video. I always love to talk with people about stocks and be able to help people as much as possible. And that's the whole reason for creating the Exponential Investment brand. Is really just to bring people together. It's more of like a hive mind where the more eyes we have on the market, the more opportunities each of us see. And, the fact of the matter is we all have our own strengths and weaknesses. And the larger those numbers get, we're able to help counteract each one's weaknesses with each other's strengths. And you just end up becoming a force, where you end up helping each other generate massive amounts of wealth. I believe in 2020, our group was able to collectively, I think we're up $500,000 collectively, and
That's
at that
incredible.
time we were only at 19 members, and that number has started to kind of go up exponentially, but hence the name Exponential Investing, right? So yeah, to answer a little bit about your question, to be honest, I'm really just an average Joe. I paint for a living. I own my own painting company. I'm an entrepreneur like yourself. And I just, that COVID crash in March, I saw an opportunity. It was another bubble burst, so to speak. We saw that in '08. We saw that previously in Wall Street. And anytime something like that happens, the market is more often than not, and it has always recovered. 100% of the time it has recovered, if not kept going. So it provided a prime opportunity to really get the most value with my dollars when I invested into these companies. It was like, well, there's a no-brainer. There's nowhere to go but up, right? And so I've only been trading now for, it's not even a year. So like I said, I'm just an average Joe. I'm no expert. I'm not registered with the SEC or nothing like that. I just enjoy talking about stocks with my friends and hoping we all make a bunch of gains,
That's incredible. That's incredible. To start this year and kind of just dive all the way in with it. You must have been really, really, excited about the market. Whenever it. You must have been really excited about the market after the crash in March then.
Absolutely. Yeah, it was an exciting time. And really, it was the people that were around me too that helped excite me as well, and we kind of just got together and we're like, you know what, let's start looking at the stock market. There's nowhere to go but up from here. We all have a little bit of extra change in our pocket, and let's, it really started with saving too. If you got, it doesn't matter how much you have to invest, but save a little bit. You can even buy fractional shares, in 20, 30 bucks at a time. You don't have to throw a whole bunch of money at it, but at least try to make your dollars work for you. You spend your time 9 to 5 or running your business or whatever. Let those little soldiers you keep in your back pocket go to work for you and mine you some more dollars, and that's, to me, what investing is.
So what do you think about what's going on with, GameStop and AMC and all those heavily shorted stocks in the market? It's been a really crazy time, I'd say.
Yeah, it has. It's really interesting. It's really unprecedented too. Never have we seen something of this caliber, and it's kind of just keeps escalating in the insanity aspect of it, and really getting to see the power that some of these brokerage accounts actually have over your money, and I would, but all in all, I really.
So you're of the
think,
belief that like Robinhood is like really messing up for making it to where they can't trade those certain companies. Is that what you're trying to say? Like,
I do think that. I don't think that's appropriate, and I think you're seeing that by the 350,000 one-star reviews that Robinhood just got, and I think you're seeing that by a class action lawsuit just got initiated against Robinhood. So yes, I do think what they're doing is wrong, and I think a lot of other people think that too. It just doesn't seem right, you know, when you think about it. Like that's my money. I knew the risk when I put it up, and so does everyone else in the stock market, you know. And I get it, you know. It's what that Reddit group did, you know. They collected together. They have like 72,000 members, right? And what they really sought out to do, from what I saw, was something what I thought was heroic and noble, and that was trying to save failing companies. You know, a lot of these companies that are getting pumped have been suffering badly from COVID. They have very negative earnings per share reports. They're bleeding out, and that's why they're the most heavily shorted stocks in the stock market, because that's probably going to print for someone who wants to short a stock, right? It's on a downtrend. And so I think what they set out to do wasn't necessarily to break the stock market or to steal from the 1%, but was to rather save companies that they loved. Who doesn't love going to the movie theaters? We all love the theaters and to be entertained. And you see that from the moderators at the very end. They're posting, did we save AMC yet? Did we get it up to a high enough value to save them? And then it started moving to kind of penny stocks that are getting ready to get delisted, such as Naked and Sundial. You know, these companies have to reverse split in order to be able to stay on the market and stay within regulation. So I don't know. I think you're seeing a movement in kind of a noble manner. And then I think, you know, I don't think it's wrong really to get together with a group of people and all just independently decide to buy a stock. Each one of those people made that conscious decision themselves. It's not like it wasn't predetermined. It wasn't like, all right, we're going to gang up on these shorters and steal all their money, you know, at least from what I have gathered, you know. And the way they try to explain it, though, is by trying to get these companies on what's called a short squeeze, which means that, you know, some puts are going to expire soon. And so if that stock goes up above that, out of that money, those contracts are going to expire worthless, and then they have to forcibly buy the shares at a higher rate than what they originally sold them at a premium at, you know. So and some of these companies, like the hedge fund, one of the large ones, I for life of me I can't remember the name right now, but
it's like 0.72 or something, or Melvin Capital or something like that.
Yes. They lost something like $91 billion on that short squeeze, which is a lot of money. I think one of them went bankrupt and actually had to close their doors, and people lost their jobs. But at the same time, you know, that company was notorious for betting on companies going down.
It's kind of a risk that you take when you bet against the market. That's just a
negative view of kind of life. Yeah, absolutely. I mean, I don't know the percentage, but I'm curious to know it, actually. I wonder how many people are bulls compared to bears. You know, is it truly 50-50? I don't think so. I think those numbers can't be 50-50, but maybe they are. I don't know.
Oh, yeah, for sure. I mean, I would think probably more people would be bullish than bearish on the market, but you know, the bears are able to make good money because puts are cheap. You know, when the stock market goes up consistently, that makes the put ratio versus the calls a lot cheaper. And, you know, whenever you do catch that time when it goes down, you make big money. So, you know, shorting is a way to play the game. I've never been a shorter or a person who liked to short the market or, you know, even buy puts or anything like that. I mean, I may sell puts if I'm trying to enter a position, but that's kind of another story. But
Right.
Let's kind of jump into a different kind of take a different path here. On this next little talk here, we're going to talk about what to do as a beginner. You know, as a beginner coming into the stock market, it can be very daunting. You know, there's all these different strategies. There's thousands of different stocks. I don't know what to buy. I don't know when to buy. I don't know what to pick. I don't know what broker to use. I don't know if the broker is going to steal my money. Okay, I don't know what's going on. You know, all I know is that I've seen these people making money on the stock market, and I want to make money too. You know, so where would I start if I was trying to kind of get started?
Education is the first place to start. Learn as much as you possibly can before you start putting your hard-earned dollars into this machine to try to hope that you get some dollars back. And it's, you know, as you've heard, it's kind of like a game almost. You know, you hear that word get used a lot to describe Wall Street and the stock market. It's a game, and the rules are getting changed and this and that and whatever. So I would say the first thing you need to do is really just educate yourself on what the stocks are, the type of metrics that are in the stocks. You know, how much is their market cap, which is like how much is that company worth right now at this certain price. How much is their earnings per share, meaning how much money do they make compared to the amount of shares that they have issued on the market. You know, you ideally want to see that in a positive manner, because that means the business is successful. So there's many metrics. I believe there's 50 or 60 just in that kind of aspect alone, where you need to kind of learn what each of those abbreviations mean. Another good place to start too is to learn how to read the graphs. You need to be able to look at a
So that's
graph and
that'd be
realize what's
technical
happening.
analysis then.
Yeah, well, you don't necessarily need to have to analyze the graph, but you at least need to understand what you're looking at. For instance, like moving averages, to like, you can set up a few lines just to kind of help you see, like, say the last 5 days, what's the average price people own this stock at? At 50 days, what's the average price people own this stock at? And just that alone gives you a lot more information than not knowing anything about the stock, you know? And so there's more and more advanced ways to look at it, and there's more and more metrics and stuff like that. But in at least be able to look at the graph and kind of realize, okay, is it going, you know, up? What do candlesticks mean? What am I looking at when I look at a graph? You know, what do the different candlesticks mean? That's an important word to Google and look that up. You know, for anyone watching, there's different patterns that the stocks do, and they repeat themselves as well. I believe it's like 75 or 80 different patterns that you'll see kind of get repeated. So that's, I
Well,
think,
what do you
two
do if,
important
like,
places to
you
start.
know, I mean, I'm just so busy. I don't have time to be learning about candlesticks and stuff. You know, I just want to, you know, buy some stocks and pick some good companies. And, you know, I don't know, what are some good companies that I should buy? You know, we'll start there. Like, what companies are good stocks to own, in your opinion, for 2021?
Well, okay, well, in my opinion, for 2021, I think there's a few different sectors that are kind of crucial to look at. You know, you're seeing like the Bitcoin, the Coinbase sectors have been really popular,
Like
and we could
cryptocurrencies and such.
cryptocurrencies. You know, so there's a few tickers like Mara, MARA, Riot, IROT.
Mhm.
What is it? MSTR.
MSTR, MicroStrategy.
MS
Yeah, that.
MicroStrategies.
Did you
That's
see
the
that one
largest
today?
one.
Whew,
Yeah, yeah.
MicroStrategy is like 620 or something.
So
It's going crazy.
that's definitely a good sector for 2021. Also, you know, the green plays. We have Democratic controlled all facets of government
So
in
by green
America.
place, you
So
mean like
green
solar
plays,
and like electric
solar. Yep.
vehicle, renewable
Exactly.
energies and things.
Yes,
Okay, okay.
yep. Those would be kind of the green play aspects. Then you also have your
Like
traditional kind of large
what kind
caps.
of tickers in those green? What kind of tickers in the
Okay,
green
Yeah, sure.
sectors do you like?
So, I mean, your electric car vehicle companies, so like your Tesla, that's probably one of the biggest ones. Next to that is NIO. They're a Chinese company, kind of pioneering the way for electric vehicles. You've got, First Solar is another company who's pretty popular with the solar panel game.
Mm-hmm.
You've also got there's a few different kind of renewable energy kind of
Mm-hmm.
companies, tickers too, that I don't know many of those. I kind of stick to the EVs because I just kind of feel that's going
Mm-hmm.
to be a short-term future. Like
I really
solar
like
panels still aren't efficient enough and stuff. So
one that you should check out is JKS. That's Jinko Solar. That one is going to do really. I'm really bullish on solar too. I think solar is going to be a really great industry. If you want to be just diversified in the whole thing, TAN. That's the ETF. If you look at the chart on that, it's almost like a straight line up. Like the monthly chart. The monthly chart is a straight line up, and I really think that if you just want to be diversified in the solar space, that's great. That's awesome. That's awesome. So what else?
there's
Tell me
more
about these
than that
large cap.
too.
Mm-hmm.
Like, yeah, I was just about to get into that. Then you've got
Mm-hmm.
your kind of large cap FANG stocks, as you'll hear that word get thrown out, FANG. So, we're talking about your Amazons, your Apples. I mean, even Facebook is one of those. Just all these companies that are worth close to $1 trillion, if not over $1 trillion. Those really large companies, 750 billion or more, companies that are just giants in the industry. And most of those are just traditionally been very successful. Microsoft, like I said, Apple,
Mm-hmm.
Amazon. I mean,
Which
there's a lot of blue
so
chips.
out of the FANG stocks, we're talking about I would say Facebook, Amazon, Apple, Microsoft, Google. I'll even throw Netflix in there. I'll even
Yeah.
throw Alibaba in there. I'll throw Nvidia is probably pretty close to one of those. Which one of those FANG stocks, FANG men? We got a
Yeah,
FANG.
I know. I know. There's more now than just FANG.
which one do you think is going to do the best for the next 12 months, and why?
Apple. I really think Apple. And let me tell
Okay.
you a little bit why. They now have more subscribers for their streaming content than Netflix. Look how much that the market cap is on Netflix. Disney just now has they're not their market cap isn't reflected by the amount of assets they actually own. Like when you have that many members, you have a reoccurring income that is
Revenue, yes.
guaranteed. It is
Sticky revenue.
guaranteed.
Hmm.
Yes, and that
Hmm.
makes you a very successful company, on top of everything else that they've done for the last 70 years or however long they've been in business. So their parks aren't even completely open in a lot of places 100%. People are still scared to go to the Disney parks and spend their money and take their family on vacations because of COVID. So I don't think Apple is completely where it needs to be. I think it has a lot of room to run. And then second to that is probably Amazon. No one is doing what Amazon is doing. They just got approved with, I think it was about 6 months ago with the FAA to be able to do
The
drone
drone delivery,
delivery.
yes, through
I think
UVIS.
they were going to start seeing
Hmm.
that pretty soon, and they're going to change the game with that. And they're just, everyone uses them, and less people are shopping in person. More
Hmm.
people are shopping online as another direct effect of COVID. So, I'm seeing those two probably being my favorites out of the fangs.
So
They're all great. They're all
no love
great though.
for Facebook, or I guess
I
Facebook
don't
is
think
technically
so.
the lowest valued out of all of them.
I
As
think
far as like from
face
a cost to how much revenue they pull in versus their share price, they're technically the cheapest.
Let me tell you a few reasons why. About a year and a half ago, Facebook changed their algorithms for people who are trying to advertise their business through Facebook. They lost a lot of revenue from people who use their platform as a business with that, because it made it to where people didn't get as much value for their dollar. So they lost a lot of revenue there. They've been under the hot spotlight from Congress and now from people with trying to silence people's their content. You know, we're talking about freedom of speech infringement, you know, and I see a mass migration of people who used to use Facebook that no longer use Facebook. I used to post and 60, 70 people would like it or something. And now you're lucky to get maybe 10 or 12, or unless you got a really good piece of content that you put out. People just aren't as active on it.
That's a great point. You know, in my opinion, the best social media stock out of the main ones is Snapchat. You're going to get, I think that Snapchat is probably going to be the best performing social media stock out of all of them. You know, you're talking, if you're looking at Facebook, Twitter, Snapchat, you know, whenever TikTok goes public, I may have to change my opinion, but the things that Snapchat is doing and the way that the stock has performed, I think that the stock was like $6 in April. Now it's pushing 60, and it's looking very, very strong.
It had a nice run today too.
Yes. Oh yeah. Great run today. I mean, and that's the thing, you know, we've had so much volatility lately. I mean, what do you think about all the volatility? It's got to be, you know, scary. I mean, as a new investor, you know, to see your stock is just like, whoa, you know, like, how do you deal with that?
Oh, you gotta deal with it, man. I don't know. Like, it's ups and downs. It's a roller coaster ride. This is how you deal with it, okay? Life is a journey, okay? So you're riding this roller coaster on this stock market train, okay? And then you're going up and everything's really exciting. You're coming back down, you go back up. But, you know, at the end of the day, that track still kind of leads upward and to the right.
It tends to go up in a 45-degree direction.
Exactly. So, you know, put your seatbelt on, sit back and enjoy the ride. You know, it's really exciting to see a stock pop and watch you get 100% gains. And sometimes you're going to lose 50% of what you had if you're taking risky plays and stuff like that. You know, you still have to.
The more risky play, the higher chance of making a lot of money, but the higher chance of like losing a lot of money than the safer plays.
And that's why I would encourage any new trader to stick to larger cap stocks, you know, stuff that safer plays, you know, that type of stuff can come with time. If you're just new to the stock market, I would steer clear of anything that's less than like $5 a share. Just don't even look at it, you know, until you
fractional shares, you can get the big stocks. You know, if you have $5 to invest, I tell people all the time, throw it on a Cash App. You know, buy your little $5 on Amazon. Throw it on a Robinhood. Buy your little $10 of Apple. You know, those type of things are way greater than, you know, throwing it on a risky penny stock with the hopes of that it'll go up. You know, you have a really, really great point. You know, it's like Warren Buffett would say, the first rule of investing is don't lose money. The second rule of investing is pay attention to rule number one. Okay.
Right.
So like the goal is to make money, but the goal is also not to lose capital. You know, you want to stay in the game for the long term. This trading can be a part of your lifestyle that you can integrate when you want to make more money. You don't have to be active to be trading and still make a lot of money. What the great thing about trading and the stock market, and what I love about it, is that it can work for everybody in everyone's situation. If you have a phone and a willingness to save and like a desire to improve your future, yeah, you can do really, really good with it. So that's just wonderful. Those
unless your brokerage accounts prevents you from buying your stock that you want.
Yeah. Unless that happens, yeah, that for sure will cause
unprecedented. Unprecedented.
All right, so okay, so we talked about large cap. We've really only talked about technology stocks. Are you saying that I only need to be investing in technology stocks? What about like, other sectors, or what do you like? What do you think about other different segments of the market?
Um, Technology is just exponential in its type of growth in and of itself. We see that just in science. So to me, technology, if it's exponentially growing, it should then be exponentially making more money too. So it just kind of logically makes sense to try to gravitate more towards technology and growth-based stocks. But a few of those that we mentioned aren't necessarily just tech stocks. But there are still other plays too. You've got like Coca-Cola, who will pay you a dividend if you want to make dividends and stuff. If you want to just have a guaranteed kind of passive income by owning a share, and then they pay you a certain amount, either monthly or quarterly, to own that share. That's a whole another trading strategy as well. So there's
Yeah, so now
many
you're
different
talking about
ways to
like
go
value
about it.
stocks, huh? Like
Yeah,
Coca-Cola
value
would be a value
stocks.
stock. Ones
Yep,
that don't
yep.
have as much growth as like the technology sector, but people would say they're more safe. But
Procter
yeah.
and Gamble,
Mhm.
um,
Abivai,
there's Johnson and Johnson. I mean, just some of these companies that have been around a long
Caterpillar.
time. Caterpillar, yeah.
Caterpillar's a great name. I wish I would have held my Caterpillar, because that name has just been doing so good.
So I mean, there's a lot of other sectors to look at too, and maybe this is just me personally, and I have a few other people that we trade with too. It seems that most of us like to gravitate towards the growth in technology stocks just because of how quickly they seem to grow in wealth.
Mhm.
Um, yeah, I mean
Capital gains is just so large on, there's
yeah.
such high, and there's a word for it, it's called beta, and beta is a representative of the volatility of the money flow. With technology stocks, they're just high beta. There's lots of money flowing in when they're doing good, and lots of money flowing out whenever they're doing bad. And generally those names have business plans to which they're going to be doing good much more likely than they're going to be doing bad. I mean, you're talking about names like Apple, Neo, Tesla, Palantir, Facebook, Microsoft, Google, Netflix. These names, Square, things like that. These names might move 10, 15% in a day.
Mm-hmm.
Maybe not like the bigger ones like Apple and Amazon and things like that, but some of these other smaller ones. And it can be, it's a lot. Uh, Whenever you see that type of growth compared to a Coca-Cola dividend, sometimes it's hard to stay with the value stocks. Even though you would think that someday the value stocks are going to have their day. I mean, they've just been underperforming for years, but maybe not. Maybe this is the future that we're in right now. And we are in the time where technology is not only the present, but it's not only the future, but it's the present.
Yeah.
So that's why we're seeing such growth in, these technology names, these disruptive technology names, things like that.
Well,
Mm-hmm.
I think it's kind of like this. What is Coca-Cola going to do that is going to completely
It's not going to
change
like
the
double
market?
it's not going to double
Well,
its
no, I mean,
revenue in one
they make
year, or like,
soda. They make soda. You know what I mean? Like, unless they come up with some crazy idea that they get this soda that magically heals you or something, they just don't have like, they're at a ceiling, so to
mm-hmm,
speak.
mm-hmm.
They that's their market, that's what they do, and that's it. There's no kind of growth to go
They
anywhere
sell a
from
lot
there.
of sodas. I mean, a
They do,
lot of
and they're good
sodas.
at it, and they're really good at it, right? And they're delicious, right? And they have different types of sodas, and they've been acquiring other soda brands and kind of monopolizing in that sense, so to speak. But they're not trying to build rocket ships so we can live on Mars,
Mm-hmm.
and they're not trying to create a chip that goes into your brain so you're connected to the internet. They're not trying to change the world fundamentally, I
Mm-hmm.
guess is a good way to put that. a lot of these large technology companies are trying to change the world fundamentally, how we live in it.
Mm-hmm.
And Coca-Cola just isn't going to do that. You know, maybe they'll come out with a new flavor that's really delicious, but it's, you know, and I think the same could probably be said for Procter and Gamble, but I mean, some of their stuff is on the health side. So, you know, Johnson & Johnson, for instance, is coming up with the COVID vaccine. They're one of the people who got a contract. So you could even say that they're a technology company as well. You know, it's like, it's everywhere. We are technology. We are
And
so
that's kind of
integrated
been
with it.
accelerated by, you know, the and I won't use the exact word because you know how the algorithms don't really like it, but the C-19 situation has caused sort of an acceleration into these technology trends, haven't they?
Yeah, yeah, definitely.
Zoom calls and, you know,
Yeah,
remote
I mean,
work and
a lot of this, I mean, shipping packages has gone up massively too. Just there's a lot of things fundamentally that have changed because of it. And I mean, Hollywood, when's the last time Hollywood's come out with a bunch of blockbuster hits? And like, our entertainment on that side is just almost non-existent. You're having to have private companies such as Netflix and Amazon try to pay actors to make shows and movies with them. You don't have a central hub where people can meet and you know, work on their art together. And so, and that's just one aspect of it. There's many other industries that have been greatly affected by it. I mean, the lumber industry is one of them too. Supply chains are so interrupted by this that lumber costs 4 times as what it did 12 months ago. So
copper. In fact, the entire commodities industry has seen a really significant rise in the last 12 months. It's going to be interesting to see commodity inflation play out over the next year. And that kind of brings me to another topic that I want to talk about, our last topic, kind of the macro, you know, taking a look at things from kind of a top-down level, you know, looking at, you know, how governments have responded to the C-19, you know, money supply, you know, the stock market, things like that. Are we going to have a stock market crash because of all this?
We could always have a stock market crash. It could happen. It can just happen at any time. We've seen that. It only takes a major catalyst, and then people get really scared. And once that happens, it's exacerbated. People just, it's like a flip of a switch. Anytime it can crash, and that's the risk you're trying to take.
Fear, uncertainty, doubt. FUD is like the term for it. You know, you put a little FUD in, the media starts getting ripping and roaring, and it's off to the races. That's exactly right. You know, we've seen it happen so many times. You know, even with things like Bitcoin. You know, whenever Janet Yellen said that Bitcoin was used for illegal transactions, which actually since 2017 it is not nearly as much, but she had said that, and then that had dropped the price from 40,000 down to like 34,000 in almost 15 minutes. I mean, you know, $1 billion got pulled out of a financial asset. You know, those type of money flows, you know, show that, and we're kind of at a toppy place. I mean, you know, we had that situation a couple days ago where all of a sudden a ton of money just got pulled out of the market. We had the situation yesterday where the stocks kind of took a pretty good dive before recovering. Do you think like we're getting ready to have a pretty significant pullback, or things are going to be fine, or there's too much money in the system?
Things are going to be fine. Okay. At any time, more can just be injected into the market. It's kind of crazy. Our government,
it's called like the I like to call it the Fed put. It's like the Fed has a put option on the market where, like, if it goes down, they will inject money in and it'll be all right.
Yeah, and there's a graph out there, and maybe you can find it for this video or whatever, but it shows you know, of that actually happening. And it just shows that the stock market really never goes all the way down ever, because that protection layer just picks it back up and it just continues from there. So yes, a crash can happen at any time, but what I would say is you should buy more shares when it happens, you know, because you're going to get all those shares at a discounted rate and it's going to come back. I don't suspect our government's markets to completely fail in the aspect of that the dollar is worthless and no one wants the American dollar anymore. That to me, it just seems very unlikely that something like that would happen. So I think your money is somewhat safe in there in that aspect, but you've got to be also mentally prepared that a crash could come. And if it does, try to stay strong and not sell for a loss, you know, because
You got to
more
have
often
like
that comes back up.
you got to have, you know, an emergency fund in place to where, you know, if your equities do go down and and there's some situation where you do need capital, you don't have to sell your equities at a loss.
Well, you shouldn't have so much invested in there that you can't. You should be, what you have invested in the stock market, you should be mentally willing to not touch it. Almost like a CD. When you go and you give a bank money for a CD, you can't touch it for 2 years, 3 years. You got to have that personal responsibility at the same time to go, okay, unless I need emergency money, which, you know, hopefully you have a credit card for that or some other, maybe borrow money from a friend, some other means where, you know, you don't want to be selling those at a loss. You know, you got to try to, like you said, have emergency fund there somewhere. And that kind of could circle back to another topic about diversifying your wealth, but that could be a topic for another day. But yeah, I think you're absolutely right. It's important to keep a little emergency for that. But back to the macro aspect of it, you were asking me about what I thought on that. What I really think is two things. Okay, we're injecting a lot of money into our economy. How many trillions are we up to now? Over 3, or is it 3.5?
Oh yeah, well over 3, yes.
Well over 3, right? So when you inject that kind of money into the economy, assets are going to naturally inflate. And next is your commodities are going to start to inflate. And now then your dollar is going to start to inflate. And we're going to start seeing that, you know, from a year ago, whenever we started getting, or 8 months ago when we started getting our initial stimulus checks, and they're still printing more money and giving more money into that. We are devaluing our dollar every time we're doing that. So that's another reason why you're seeing the stock market go up in such a bullish pattern as well, because there's so much wealth getting just pushed into the market. And people nowadays are learning about the stock market, and they're taking that money and investing it into the stock market, and it's kind of pushing it even more, so to speak. So, and they're talking about another stimulus package. So, you know, and you don't want to keep that money underneath your bed. That dollar today is probably only going to be worth 90 cents 5 years from now or 6 years from now. For all this money we're pumping into the market, I mean, I couldn't tell you the exact number, but it's going to be worth less than it is today, most likely. Okay. So if you keep that money in your shoebox underneath your bed, those dollars aren't going to go as far 10 years from now. So if you put them into the stock market, they will be protected against inflation and in kind of in some sort of way, you know.
And that's another interesting thing about the macro side too, because generally if you had wealth and you wanted to protect it against inflation, you would put it in CDs, you'd put it in treasury bonds, you'd put it in bonds, you'd put it in, you know, the risk-free assets. They're almost worthless now. There's
they don't pay enough
always.
interest. They don't pay enough interest, okay? There's something in macroeconomics called a real interest rate. And what that means is there's a rate of inflation that happens for every economy, every dollar, every yen, every currency inflates at a certain rate every single year, okay? Whatever that rate is, and I think usually in America, it's anywhere from like 1.75 to 2.5%, okay? So take that number minus what that CD is paying you for your money. What are they giving you? 1%? You're losing minus 1% from 2.5. You're losing 1.5% on your money every single year by letting them have your money and you can't even do anything with it. It's like, why? You shouldn't do that. Don't do that. Don't give
It's
me,
like
don't
almost, it's
buy
like
CDs.
the real rate is negative.
Right. But I mean, it's better than keeping it under your in a shoebox under your bed, because at least you are making
I'll be
something
right
off
back.
of
Hold
it.
on 1 second. What a noise. Make sure nobody was running up on me. All right. We'll edit that out, no problem. All right, shoebox under the bed.
Yeah, I mean, you're a little bit safer, I guess, in that negative real interest rate if you put it in a CD. But to me, it makes more sense to even put it in a ETF, or just in the Dow, or just in an index, because those traditionally go up at a higher percentage than any CD, and you're going to actually make money off your money than lose it every single year. So I think that's, in my opinion, a smarter way to invest your money. And it used to work before, because they used to pay good interest rates, but the banks don't do that anymore. They really don't. You know, what they're trying to do is loan money to you at a nice interest rate. That's what they're trying to do. You know, they've figured out a way to have saving and checking accounts. They don't need people's money via CDs and bonds and stuff anymore. They have the money already. And I don't know, that's just kind of how I feel about it.
Well, that's been great. You know, guys, this has just been a talk with Des and Justin Petrillo. If you're just joining us here, Justin is the founder of Exponential Investing. It's an investing group on Facebook, and an investing message group where we talk about the plays. You know, I'm one of the founding members of that group. You know, I just wanted to bring him on and kind of get his, his feelings on investing and his kind of thought processes for, you know, the different facets of investing. So Justin, before we let you go, tell us how to find Exponential Investing, and where can we find it, and you know, any of your social medias, if you want to drop those, you can in this moment here.
Yeah. So it's Exponential Investing. It's just a Facebook group. It's the letter X and then Ponential. So it's kind of a little bit of a play. The X should look like a stock going up and a stock going down. So you just search that in Facebook. You'd be able to find us pretty easily. You could also, you know, look me up, Justin Petrillo. There aren't many Justin Petrillos in the world. You'll be able to recognize me pretty easily, and send me a friend request or something, and we'll get you joined up onto the group. You know, we'd be happy to have you. We don't charge anything for the group. It's completely free. We do this just because we enjoy it, and we like sharing our experience with people. And it's awesome when we all make money together and we're all gaining, and we're helping each other build more wealth. So you know, we're pretty respectful of each other. We're pretty encouraging of each other too. You don't see much politics or negative emotion in the group. I try to police that somewhat to an extent to make sure that everyone's really respectful of each other. I think that's really important when you bring a group of people together, to have that mutual respect. And I think we've got a great group who understands that. So if you're ever wondering of, hey, is there somewhere I can go to just pick up a little bit of information on investing and join a little bit of a little club with some people, definitely come hop on the Exponential Investing train. We'd love to have you.
Well, Justin, it's been so great having you today. Again, this is Des Morris with the Des Morris Investing Channel. Thanks again for watching. Be kind to each other and have a great day. Take care. Bye-bye.